Ladies and gentlemen, good day and welcome to Mech Projects Limited Q3 FY26 earnings conference call. As a reminder, all participants' line will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Kundnani from Nirmal Bang Equities. Thank you and over to you, sir.
Thank you, Ikra. Good morning. On behalf of Nirmal Bang Institutional Equities, I welcome you all to the 3Q FY26 earnings calls of Mech. The management is represented by Mr. S. Kodan Ramaya, Director Non-Board, Mr. N. Nani Arvind, CFO. Now I will hand over to the management for their opening remarks, which will be followed by the Q&A.
Good morning, everyone. I am Arvind, CFO of the company. I have with me Mr. S. K. Ramaya, Director Business Development. I would like to extend a warm welcome to all of you joining us the Quarter 3 and 9 months Financial Year 26 earnings call today. I take this opportunity to welcome you all to our Q3 FY26 earnings call. As we reflect on our performance during the third quarter of FY26, I am pleased to report that the company has continued to execute on its growth plans with strong results across all key segments. This quarter has demonstrated the consistency and scalability of our business model, with our core segments contributing to the positive momentum. For Quarter 3 Financial Year 26, the company recorded total revenue of 1,433 crore, reflecting 6% growth compared to the 1,347 crore in Q3 FY25. This increase was driven by sustained execution across power, O&M and emerging segments such as mining and civil works. The O&M business in particular performed well, supported by new order inflows and strong execution of ongoing contracts. EBITDA for the quarter was 173 crore, up 8% year-on-year, with EBITDA margins at 12.08%. The margin remained stable compared to the previous quarter, with a slight dip due to provisions created for compliance with the new labor code. The underlying operational performance, however, remains strong. Profit after tax for the quarter was 100 crore, marking a 15% increase from 87 crore in Quarter 3 FY25, with the PAT margins improving to 7.02% from 6.47% in Quarter 3 FY25. For the 9 months ended December 25, the company achieved a total revenue of 3,987 crore, reflecting 17% increase compared to the 3,409 crore in the same period last year. The strong 9 months performance was largely driven by the ramp-up in our key verticals, particularly in O&M and industrial power construction projects. EBITDA for the 9 months period was 513 crore, a 23% increase over the previous year, with EBITDA margins improving to 12.88% from 12.2%. PAT for 9 months was 258 crore, a 19% increase over 218 crore in the same period last year. The geographical mix for the quarter was 95% domestic and 5% international, while power sector contribution remained at 70%, with non-power sector accounting for the remaining 30%. And revenue mix for 9 months, the geographical mix for 9 months was 95% domestic and 5% international, while power sector contribution remained at 67%, with non-power sector accounting for the remaining 33%. From an order inflow perspective, order wins during the year to date have reached about 6,761 crore. We are progressing towards achieving 10,000 crore order intake in FY26. During the quarter, we secured several large and strategic orders across EPC, O&M and new energy infrastructure. A key award includes a large BOP EPC package for the 800 MW Singareni thermal project from BHEL, which expands our scope from execution packages to integrated EPC delivery in BOP systems. We also received a grid-scale battery energy storage system project under build-own-operate model from state utility, which marks our entry into the utility-scale storage assets with long-term contracted revenue structure. The total order backlog, including MDO projects, is about 56,800 crore, 70,300 crore excluding MDO orders. The executable order book provides multi-year revenue visibility across power, civil, EPC and O&M segments. The order pipeline remains active across thermal, balance of plant, civil infrastructure, railways, and energy transition projects. So the company's operating cash flow has improved, reducing from minus 253 crore in 9 months FY25 to 113 crore in 9 months FY26, primarily due to realization of receivables during the period. This is further expected to improve operating cash flow and reduce reliance on working capital limits. Gross and net debt levels remain well controlled despite delays in certification of water bills and realization of receivables. As on 31st December 2025, the gross debt was around 833 crore and the net debt was 233 crore. The average debt equity ratio as on the same date was 0.35 times. In summary, we are pleased with the progress we have made during Q3 and the first 9 months of FY26. The company's diversified order book, strong execution across segments, and strategic focus on high-value projects continue to position us for sustained growth. With a solid pipeline of orders and ongoing project execution, we are confident in achieving our full-year targets and driving long-term value for our stakeholders. With this, I now request Mr. Ramaya Garu to update on the key business development initiatives and future outlook.
Thanks, Arvind, for your initial numbers and all the key aspects of the activities of the company. And I also thank our investor community here. And to carry forward what Arvind has said, particularly in the business side, I think we continue to drive on the investment, bullish investment profile in the country across various sectors. And as a company which is strongly embedded in the power sector business, we continue to drive the power sector business with a lot of opportunities. And then having diversified to infra and non-power sector, and IO also, there is a continuous opportunity available in various sectors, and that is how the order booking has been consistent with our expectation. And overall increase in the order backlog has gone up by 10% from 14,387 to end of the quarter to 15,764 crores. And the key aspect of the driving of this increase in the order backlog is due to the key order we have received for the first time, a comprehensive EPC order, the two in a native state in Telangana, which drives the business better for us because of the customer interaction and all, reach and all. And that has helped the company to grow in many sectors with the 2,550 crores. And balance out about 300 crores orders are mainly in O&M in the domestic and international market. The mechanical side of the business has grown from, the backlog has increased from 2,303 to 2,959 crores, increase of 28.5%. Civil has grown up from 8,472 crores to 9,103 crores, a growth of 7.5%. And then O&M, the last year order backlog was 2,749, now it is 2,522, a small dip of 8.2%. And electrical also has seen an uptake, mainly because of the electrical portion of the business we got in the EPC, that contributes about 280 crores, which has increased the electrical backlog to 18.3%. And the domestic business continues to drive the market because of the opportunities, and international we are focusing mainly on the O&M and short-term contracts with high margins. That is in line with the company's goal of improving our margins. And these are the key numbers as far as the business profile is concerned. Now, this year's target of 10,000 crores, what we discussed with the team, the investor team, and what we have got all opportunities around 5,162 crores, mainly driven by Adani. They are investing continuously and they are taking the decisions in ordering. And then O&M, there is a strong profile of opportunities with Vedanta Group, and these two groups should enable us to reach the targets reasonably. And what has been recently a great breakthrough had been in the business of energy storage. In fact, energy storage is going to drive the business substantially with the first breakthrough of what we received for a 250 megawatt energy storage project in West Bengal. That gives a daily availability of 10,000 megawatt hours. In fact, energy storage, both in the form of battery storage and the pumped storage, are going to be the future growth engines for a company like us, and it brings the synergy into the system based on our expertise in execution and also engineering expertise we are gaining it. And this energy storage, both in the battery storage and then the pumped storage, is required to balance the power grid stability, and we will be contributing in a little way our contribution to that. And this project, with a 1,000 megawatt hour output and an expected revenue of nearly 103 crores per year over 15 years, that will give a overall revenue of 1563 crores. And it involves a capex of about 800 crores, and that we have got a consortium of partners with, led by Mech at 51%. And this one, the short duration project, 18 months, and facilities are available, land is not a problem. There is a proper contract with West Bengal Power Development Corporation, and then the agreement is in place, and we have to now get going on this project. And the battery is the main part of the this investment, and the balance of systems is mainly the electrical systems and balancing facilities and all. And that is a key breakthrough. And then Singareni, as we said, 2,550 crores. It has got the three components of the business. Of course, engineering integration has to be done. Then lot of outsourcing and integration of the in-house expertise in construction and engineering coordination, project management, we have to take it up. And out of 2,550 crores, the breakup is mechanical is 1,550 crores, civil is about 720 crores, electrical is 280 crores. Therefore, that drives the business in all these segments, and that will be, the schedule is about 38 months, and there is a fair payment terms available from BHL. This has been taken from BHL. And with a 10% advance and then retention of 5% only. And now we are aggressively driving the business, and we have taken up on the board some of the experts in the balance of plant business in the country, and they are leading the team. And already a lot of engineering work has been taken up. October is the zero date, and we in fact after 38 months schedule, we would like to do it at a shorter cycle time. Based on the drive and the inputs, we can drive it. Already a lot of initial action has been taken in engineering, and also some ordering has been done in the key packages in coal handling, ash handling and cranes. And most of the balance ordering should be completed by April, May, key major orders. That should help us, and already site work are already taken up. Therefore, this is the main aspect of the two businesses we have recently taken. And now, coming back to the major business segments, sorry. Power sector continues to drive the business, and as we have seen, almost 66% of the business is on the power sector driven. And now looking at the investments coming in the way, Adani Group is a major player in terms of the capacity addition and ordering. And if you look at the last 2 years and plus, where the continuous flow of investments are coming up, and then the key players like BHL and NDT are getting the orders. The major players in this segment are the Adani, which has got a profile of 24,520 megawatts of ordering, and substantial ordering they have done. And then NTPC is about 12,380 megawatt. Other key players are Damodar Valley Corporation, and then Mahajan Port Koradi. Then Singareni, recently we have taken the BOP job, and then various electricity boards altogether. The capacity ordering which has been done in the last 2 years, it has gone up to 54,740 megawatt. And in these two players are the main beneficiaries in that, the EPC and the ordering aspects, and both is of interest to us. Only the BHL with a total ordering of about 37,140 megawatt, they have got nearly 2 lakh crores of orders over the last 2 years. And L&T has come back into the play, as we have brought out earlier also. Apart from the Nabinagar and Gadarwara, where they have taken from the NTPC 2 key main plant orders, Adani has diversified the ordering apart from BHL to L&T also in 4 projects in Assam, Korba, and then new projects. These have to be identified, and that is helping the L&T profile for about 12,800 megawatt with a order booking of 42,523 crores. And therefore, these two players are going to play a major role, and BHL is a key customer for us, and our excellent relationship from the point of view of performance, consistent ordering on us. We continue to expect orders from them. And then Adani has been an important part of our business growth, and substantial ordering also is there. And the current status is that as on today, out of this 49,940 aspect of the work orders, this one megawattage, nearly about 12,900 megawatt ordering has been completed by BHL, and balance tendering is of 24,000 megawatts, and then tendering balance by Adani is about 18,400 megawatt, and that transfers to opportunities is of plus 60,000 crores in various sectors. That is in the contracts in the terms of civil, structural, mechanical, and then associate auxiliaries, and that should help us to continue the growth profile in the power sector business next 2 to 3 years. Now, one more aspect in this capacity addition of what is going to be, as has been ordered, is that these opportunities will also drive the O&M, which I expected 8,000 megawatt to 10,000 megawatts of commissioning every year. Of course, last 1 or 2 years there has not been much of progress. This year about plus 4,000 megawatts have been added to the grid. Even though the Central Electricity Authority has kept a target of 16,000 megawatt, there can be some shortfall. But our expectation is about 8 to 10,000 megawatt and average should be added. That should help us to get a O&M profile of roughly 10,000 crores in the next 5 to 7 years. That means apart from the existing O&M profile, these are the new ordering which will happen, and that will increase our O&M presence in the market. Now, the key sectors of the business, as I told you, apart from this one, there are opportunities in the infrastructure, railways, roads, and then another aspect we are trying to look at is the mining and material side. NMDC is coming with an investment of for a 50 million ton extra additional iron ore capacity. Then Steel Authority is having an investment profile of more than 1 lakh crore. And we have already started participating in these tenders. NMDC for their 2 mining projects with they have called tenders for about 30 million tons of capacity addition in the iron ore. Then 20 million tons tenders we are participating. And then the ISCO Burnpur, part of the Steel Authority of India, has got an investment of about 45,000 crores, and they have about 2 jobs we have quoted for about 2,200 crores, and there are other opportunities also expected. Therefore, mining side, steel side, and then O&M side, we continue to expect the opportunities. As I said, on the power sector itself, there will be 1,200 additional opportunities crores every year, apart from the renewal of the projects which will take place. That should substantially increase the O&M profile. Then the organization is also quite geared up in terms of resource management, in terms of capacity building, and then training of the people, and then handling the higher market size of the O&M business. And we have the manpower strength has gone up based on the business requirements from 40,000 in the beginning of January 25 to by December 25 it has reached about 48,000. And O&M is continues to play a key role in terms of about 18,000 skilled engineers, supervisors, technicians, and operators with very high skill base, control room operation, field management. These aspects have been taken up. And the important thing of the O&M is that we are a leading player which have reached a profile of about 75,000 megawatts. And recently, about 4,000 plus megawatts also, the additional jobs we have taken from Vedanta Group. And that will add to the profile. And the key aspects in this is our consistent performance with reference to the availability guarantees 90 to 95%. auxiliary power capacity, meeting their parameters, and then specific fuel consumption. These are the most important things for driving the higher margins for the owner. The better these parameters are maintained, better is the availability and also generation. And that is how the renewal of the O&M orders comes regularly in the O&M sector. Therefore, as they balance immediate opportunities, we are targeting about 4,500 to see that how much we can meet our target of 10,000 crores in the current year, mainly from Adani, BHL, and possibly a few other O&M orders. Then the continued investment, I think recently we have seen Government of India is planning a capital investment of 12.5 lakh crores in the infrastructure and other sectors, from more than 10 lakh crores. And that should open up a lot more opportunities in the coming year also. And we continue to depend on these type of new investments from EPC players like BHL, and then customers like Adani, and then all our valued customers in the power sector, and also infrastructure in railways also. Investment is there, but the competition seems to be pretty high, and same is the road sector. Therefore, that is based on what we would like to take it, based on our capacity to handle it, and also our interest in how much margin we should keep it up. And then the metros are also growing up. Therefore, company having diversified long back from the power sector to non-power sector with about 35-36% in the non-power sector, that growth remains consistent, and we continue to drive on these new capacities and also opportunities. Thank you very much.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Pritesh from Lucky Investments. Please go ahead. Pritesh, you can go ahead.
Yeah, hi, sir, just a couple of questions. One, on this 17,000 crore backlog, you always have fairly strong backlog and addition of orders. How much of this 17 is where the execution is slow, and what are the challenges there? And if you look at your execution for the first 9 months, vis-a-vis the accretion in backlog, the execution is slightly weaker. So maybe you want to call out some comments on these two areas, please.
Yeah, out of this 17,000 crore of order, so the execution challenges are not there. Mainly, some of the new orders we received during the last year, there was a delays in the starting of the projects because of the extended monsoons during the last Q2 and Q3. And some of the projects like Kaiga, where extended monsoons, and Mirzapur is one project where environmental clearance issues are there. So there are delays in starting the projects. And we expected, Yadadri Township project also expected some major revenue in Q2, but due to rains and delays in the starting of the projects, impacted the projected revenue. Apart from there are no challenges, all the order book, what existing 17,000 crore order book is executable order book. There is no long pending order book in this.
Does this still include the FGD order, or this excludes now the FGD order in the 17,000 crore?
We have removed this last financial year itself, the 4,260 crore FGD order. This is without FGD order, only 936 crore of OP project only running in the FGD.
Okay. And, on the new areas that you have taken, that is balance of plant order or a best order, or all these new areas now, here, what is the margin profile, and have you compromised any margins?
So the BOP EPC is new line where we were planning to enter into to scale up our operations, to expand our scope of execution from number construction activity to the EPC delivery in BOP system. In BESS, actually, Power Mech has been in the forefront for India's energy growth story, and we do not want to miss the energy transition phase as well. So we have formed a 100% subsidiary as a PM Green for this, and this is a small attempt to see where the renewable segment fits into the Power Mech's vision of sustained growth and margins. We are cautiously optimistic about this segment, and we will we are investment of around 16 to 18% IRR we are anticipating on this projects on equity investments.
Ramaya here, regarding the Singareni, I think what we have to also look into is that the synergy the company brings about in the execution of on a backward integration basis. As we said, we have strengthened with a very strong engineering team, engineering and project management team. And moreover, that in-house value addition is substantial compared to other BOP players where they have to outsource everything because of our capacity in different segments and site execution. Civil constitutes almost 25% of the total segment, and then installation work, services job, and then some of the other local sourcing, all this supply chain management will be able to do. And more importantly, there is a provision of an advance which helps the working capital management, and the retention is only 5%, which can translate into better cash flows. And then escalation provision also, which compensates for any variation in the prices. Therefore, and then the nearness of the site for better access and execution. Therefore, the basic strength, as I said, is an in-house capability substantially in execution and outsourcing, and that should help us to see this project is done properly and also reasonable margins.
So my last question is on the revenue side. So what growth do you expect now on the full year number? And the MDO business, what is the profit now expected next year? Don't give us for this year, but next year, what is the profit expected out of MDO? And what is the revenue growth on the contracting side expected?
Revenue growth this year maybe at 17 to 18%. We may try to touch even 20%. Sir, we are targeting 20, but may touch at 17 to 18%. And the margins of MDO is concerned, the second mine, KPP mines, just started the revenue generation, and we touched 41 crore for 1.5 months of revenue in the Q3. And Q4 we are projecting around 100 crore from this KPP alone, and overall we may touch around 15-16% during the current year. And next year the production ramp up will happen in the KPP mining, and our washery in Tasra will be ready by December, so only 1 quarter only will operate with full capacity. So the ramp up will happen from 28 onwards, the major ramp up in the margins, but next year we may touch around 60 to 17% range of average EBITDA we can expect from the MDOs.
Okay, sir.
Thank you. The next question is from the line of Mohit Kumar from ICICI Securities. Please go ahead.
Hi, good afternoon, sir, and thanks for the opportunity. My first question on the revenue guidance, sir. I think we had given revenue guidance of 6,500 crore, if I'm not wrong.
Okay.
Are we on track to achieve that, or is it? Are you guiding a lower number now?
Yeah, out of 6,500, we projected almost 700 crore from the UP Water Division revenue. But in last quarter, we revised this guidance to the 6,100 to 6,200 level. And now, based on the still 9 months of growth trajectory, 17% growth, we may touch around 6,000 crore because now Singareni is also started billing. Now we're hoping that top line may surge by another 100 crore from Singareni, and again the mining also ramp up happened. So we are expecting around 6,000 crore we may touch this year.
Understood. And what was the mining revenue for the last 9 months?
Sorry.
What was the mining revenue for the last 9 months, and how do you think it will shape up in FY27 and FY28?
This quarter we touched almost 41 crore we recognized from KPP, and 29 crore from Tasra. and expecting maybe by next quarter 100 crore from KBP and 30 crore from KTMPL. So 130, we may touch around 250 to 260 crore this year overall.
And so how do you think about F27, F28 given the progress?
27 we touch around 600 to 700 between, depends on the scale up of operation KBP and the likely uptake of client. And FY28 we may touch around 1800 to 1900 with escalation value.
And if I remember correctly, I think there was some washery or something was I think pending for Tasra, right?
Yeah, as per the timeline, we have to complete this by this December end. So we are on the track now. All the activities at the washeries are under process, and so we are hoping that by September we are targeting to complete the washery, and by December we will be ready with our washery.
Understood. My last question is on the prospect list, especially for the coal EPC. Of course, there are a number of coal projects which I think construction has started. Do you think that, of course, compared to the fiscal when it started in April 25, are you seeing the prospect list getting bigger? And are you getting more confident for F27 order inflow from this coal EPC/BOP?
Yeah, I think BOP is going to be an opportunity. 3 more projects are expected because practically BHL has got a lot of in-house capacities filled up. And they are also trying to see that outsourcing is a better option, and with very capable parties like Power Mech and all who are strong on execution, because BHL's problem is in execution. And then that is how they would like to balance it. We are expecting 3 more opportunities, maybe another nearly 7,500 to 10,000 crores of opportunities, but it is a question of call. We have to take it on that BOP. But what is expected is that in other sectors also similar opportunities are expected to come in EPC and mining and mineral sector also. As I said about NMDC on a good basis, and then the steel business also it is there, and then infrastructure. Therefore, this company has based on the organization strength developed, we are quite confident couple of projects we can handle it because of the in-house synergy available.
So the private thermal EPC, do you think, do we have a chance to take those opportunity?
Yeah, that is, it is a competition. That depends on how do we position ourselves based on our interest and also the margins we have to keep it. And more than that, the number of players or competition can also be less in the segment for BHL, maybe 2 to 3 players. Of course, recently the ISO group has entered in a big way. They have taken a couple of jobs in Koradir, Raghunathpur, etc. Because of every organization, they are BOP, they have their inbuilt strengths like Tyson Group on the coal handling. That is how they are entered, and that is a qualification for them also. And for us, our execution capabilities, that is how that can be. But it can be maybe 3-4 players maximum.
So my question more of the like Adani, Torrent Power, JSW. Adani, of course, the pipeline has only ballooned, and I think we are working with Adani a number of projects. So does that part of piece, do you think that is a very large prospect, and you can get some meaningful order inflow in the next 12 to 18 months?
Yeah, Adani's basic philosophy of outsourcing the supply chain management is that, they try to in-house manage their engineering and supply chain orders. Now, unless like BHL, which has come to the stage of ordering more on the balance of plant and on a turnkey basis, Adani still, keeps those engineering in-house, and they have got a strong support system from consultants. And then key supply orders, they have got a very strong supply chain in major equipment like coal handling, ash handling, water systems, electrical and C&I systems. And they would like to outsource it to the extent possible on execution side strongly. And that is where, we are the preferred vendor for them. And we have got a strong relationship with them, mainly depending on our performance only. In fact, our presence in Adani is substantial. As I said, it is coming to Adani, it is more than 2,500 crores, about 7,500 megawatts we are working. And in the case of BHL also, it is a similar thing. Therefore, with as I explained earlier, Adani's ordering balance backlog is there. We continue to work with them, and recently also we have got some more quotes for some of the jobs in Mahan Stage 3 and then Amar Contact, etc. Same thing with the JSW also.
Understood, sir. Thank you and all the best. Thank you.
Thank you. The next question is from the line of Rishabh from Nexa Securities. Please go ahead.
Hello. Am I audible?
Yes, sir.
Thank you for the opportunity. Actually, I just wanted to ask about the revenue guidance for FY27 and why you revised the guidance for FY26 from 6,500 crores to 6,000.
Yeah. So FY27 guidance revenues will come with the guidance after the full year. But based on the order book, so far we are on the course to achieve at least 20 to 25% growth, and also improvement in the margin profile depends on the mix of O&M and increase in the MDO order. So we are confident of getting on the the financial March number, and that 20-25% growth we can project for the 27. And 26 guidance, we projected 6,500 crore. In earlier explained to Mohit also. 700 crore of revenue we projected from the UP Water division, where because of Jal Jeevan Mission, where the central government funds were not allocated and bills were uncertified. Because of that, we have not received any recognized any turnover during the current year. That impacted the guidance of 26. So which we are mitigating with the increase in the new orders and other alternatives. So even though it is 700 crore shortfall, but we are managing 200-300 crore extra by way of doing extra revenue from the other new orders.
Now, coming back to what Arvind said, with a present backlog of 17,326, and if we take the normal conversion margin of about 40%, it should reach reasonably 6,000 to 7,000 crores. That is a fair game. Plus what we expect to get in the first 2 quarters of the next year. That is how the revenue gets fixed up. That's why there can be growth also. Like this year we had a growth from 5,200 to 6,500. This one plus. The same growth is also expected in the coming year also.
Okay, sir. Thank you.
Thank you. The next question is from the line of Amar Ahir from Raiden Capital. Please go ahead.
Hello, sir.
Yeah.
Can you help me with the geographical mix of the order book,
Yeah, I think coming to domestic and international, it is 95% domestic and 5% international. And let us look at the investments where they are taking place. They are taking place in east and north and east, and to some extent south and west also. Therefore, I don't have exact figures of the breakup, but our substantial power plant works are mostly going in the eastern side and northern side, and to some extent on the western side also. Whereas the infrastructure is spread out all over the country, it's a question of where we are going to take the call. Railways and then roads, we are working in, for example, in Chhattisgarh we are working, in Andhra we are working, in Tamil Nadu working, then Maharashtra also we are working, and then UP, for example, Jal Jeevan Mission we are working in the UP. That is a opportunity wherever it is available based on the selection of the projects and our interest on that. We are taking it. As far as geography is concerned, Power Mech has got one unique strength. We are capable of executing the job even in the eastern sector also. That is how we have seen a strong presence in eastern sector recently. Now we are trying to look at the opportunity in Assam also. We have got an experience working in Assam also. It is not a challenge for us to say West Bengal is there or Odisha is there or Bihar is there. And all these places we have got a substantial presence in working.
Okay, sir, got it. And could you help with the breakup of the 17,000 odd crores across erection works, O&M, civil works, electrical?
Around roughly around 3,000 crore for the mechanical power ETC business. Civil is around 9,100. That includes all water, sand mines and mining. O&M business of around 2,500. Electrical 1,000 crore. And solar 159 and BESS 1563.
Okay, so that's all from us. So thank you so much.
Thank you. The next question is from the line of Devang Shah from All West Investment Managers. Please go ahead.
Yeah, hi. Good morning, sir. I just want to know the way you are anticipating next year, what kind of, your order inflow we can expect in general, and also on our MBO business also, if there is anything, for the FY27.
Yeah. No, looking at the opportunity side, as on today we have mapped opportunities of about 1,30,000 to 40,000 crores. Of course, the balance opportunities we are probably looking about 3,500 to 4,000 crores in these 2 months, and we are vigorously following that. That is spread across different sectors. It is spread across, and therefore, power sector will continue to play a major role, and then railways and roads. And then O&M also, there should be more opportunities coming up with more plants getting commissioned. And then also in the ETC business, we have seen, as I told you, the total opportunity size in the contracts on power sector itself is plus 60,000 crores. We hope substantial portion will be ordered based on the how much is the push comes from the BHL side. BHL has to do a lot of ordering, and then Adani is doing timely ordering. And then we are waiting for the actions of L&T also, about 42,000 crores. Of course, our interest is in the site construction, execution, EPC, that we have identified 60,000 crores in item rate contracts, and around 9 to 10,000 crores in balance POP contracts.
So maybe around 10,000 plus only we'll look at next year as the guidance on the order inflow is concerned. Regarding MDO is concerned, this year we will touch around 250 crore turnover. And second, Tasram and also Austria will be ready by Q4 of 27. So we are projecting around 600 to 700 crore of revenue from the MDO together.
Okay, so it's fair to assume 10,000 crore in normal in your business, we may expect this kind of opportunity, as an order inflow for the FY27. That is their minimum level. Am I right, sir? Am I understood correctly?
That's right.
Second, sir, as far as capex is concerned, what would be your current year FY26, the capex that is trajectory is going on, and looking forward in FY27, what kind of capex you are looking for?
Yeah, right now the regular capex in the Power Mech is only 100, 120, depends on the order inflow, regular capex. And washery we are constructing in our books, so around 280 crore this year will approximately 280 crore will incur, and the next year maybe around 400 crore. Total 680 to 690 crore of capex will incur on the washery itself. So 380 you can take the current year and 520 crore next year.
Next year you are saying 480 crore, right?
This FY26 by March, you can take roughly 300 out. Cash outflow will be 380 in advance form, but that will be booked as a capex post receipt of the material. So overall this year and next year together around 690 crore to 700 crore as a washery cost in our books, and 100 crore to 120 crore on an average on the regular capex, the cranes and the vehicles.
Okay. And sir, the way you are saying, now the MBO business is also started to, contributed in the revenue, and FY20 onwards, it is going to have a significant contribution. So, currently we are having some kind of, operating margin somewhere close to 12%, and you are saying there is some kind of improvisation we are going to see in FY27. So what kind of number we can expect as far as range is concerned, about 12%?
Yeah, so they're starting with 0.25% minimum EBITDA jump, and after that, year on year, maybe 0.5% jump till we reach the peak rate capacity. By 29 onwards, you will get peak of 13.5 to 14% EBITDA margins.
So somewhere close to 12.5% we can expect from initial level.
Yeah, so the last year it was around 12.3 level, and we will maintain maybe 0.25% extra. This year we will maintain at 12.5. Hoping that this will maybe increase of 0.25 year on year, and once we reach the once we are ready with our washery by 28 onwards, maybe 0.5% jump will be there in the margins.
Okay. Thank you, sir. Okay.
Thank you. The next question is from the line of Rajesh Kumar Rathi from Right Shopping Private Limited. Please go ahead.
Yeah, hi. I'm not sure if somebody has asked question before I was late to join. I have questions regarding the new labor laws. Industry sources are telling me that post implementation of the law, especially for the contract laborers, the cost can go up by 8 to 12% because of the PF and ESI matters, etc. Do you concur with that view?
Yeah.
No, it is an important point what you have raised. You see, minimum wages is a government prerogative, but most of our contracts are also tied up with the minimum wages as part of the price variation. And that should reasonably offset in terms of cover up any increase of cost and all. And any such type of statutory variation, the government notification, if the provision is not there, it becomes a matter of issue. And previously it has happened in 2018-19 also. Similar problem came up. Finally, government settled it, and most of the contractors, public sector companies, even private companies also started implementing it. That means the variation was allowed, and finally we got the compensation. Therefore, we don't expect any impact on that because it is fairly covered in the contract provision itself, because we put a very specific thing. Our prices are quoted based on the existing minimum wages, and any variation, that means except for the normal variation which comes as a PVC or the price indices, the ad hoc revisions made by the government, it is subject to a variation clause. So that way we are confident it can be covered up.
So change in law clauses will kick in, sir. We can claim with the client on the difference of cost. All the existing contracts we can claim, but for the new contracts we can load the additional cost and we can submit our tenders.
Yeah, of course, for the new contracts you can do that. But what about the MDO and non-government contracts? I don't think they generally accept that labor cost increase clause, etc.
No, there my client is Steel Authority. I CPC contracts for me. This is not a investment case for me. So the Steel Authority and Central Coalfields will compensate that. PVC clauses are there in that. So in that we will cover this additional cost.
No, these ad hoc prices will still be covered in the MDO contracts or the contracts, because the prices at which it was quoted and taken based on the conditions existing or the whatever the levels of pricing were available for the minimum wages. If there is a substantial variation as a government directive, that is subject to contract variation.
The part of this pricing, sir, in the MDO contract, labor indices are also part of that escalation clauses. So accordingly,
I see. So you don't expect any dent on the EBITDA margin?
So majority of our projects are construction projects only. They are not into EPC engineering and all. So majority covers all the escalation clauses.
Almost 75 to 80% of our contracts, except for private, is covered under price variation. And then statutory variation or the ad hoc revision is also is a matter of basic or contract offer.
So you don't expect any dent on the EBITDA margin?
It will not have any dent, sir, but for the company employees where you'll have marginally, we have to shift the...
That's the one time.
That's one time, and the 4.4% we created this quarter.
What about production slowdown or some disruption? Because I'm told that this contract labor thing, a lot of paperwork has to be done, etc. So will it slow down the process a little bit for a couple of months or so?
No, I think some of the labor contractors are demanding some other additional benefits and all. So for that purpose, they are fighting. I don't know. Government already looking into that, and if any changes are there, it will not have no impact on our financials. It will impact the employer's financials.
Even in the 4 years, there is always a case for the contractors and labor people to start for a rise in the minimum wages, basic wages.
Yeah, because I am told there is a bund today due to all this by this contract labor group, etc.
That is by the farmers against US trade agreement.
Okay. Yeah, that's all from our side. Thank you so much.
Thank you. The next question is from the line of Hitali Shah from Shriram Mutual Fund. Please go ahead.
Hello. Yeah, I wanted to know the breakup of the order inflow, the 6,700 crores in the various segments of mechanical, civil, O&M and all.
Mechanical is around 1,600 crore now. 2,063 crore from civil, O&M 1,097 crore, electrical 280, solar 159 and BESS 1,560, which comes around 6,761.
Thank you.
Thank you. The next question is from the line of Mudit Bhandari from IIFL Capital. Please go ahead.
Hi sir, out of total order book of around 17,000, what's our pending order book for JJM UP? And have we done any execution within this 3Q or 9-month FY26?
The pending order book is 1,000 crores, sir. We are not because of the fund issue, certification issue. We are executing only the O&M projects where once 100% completed projects, we are bringing these projects into the O&M phase. So 250 schemes which we have converted so far, and we were going to start building this from Q4 onwards. The existing pending works, till the clarity from the government on the allocation of fund, we will slow down on the execution of these works. Only to bring the projects into the O&M phase only, the balance minimum requirements only, we are infusing funds and we are using. And that this year we received almost 140 crore from the Q1 to till YTD, and 140 crore we received from the state government. Another 100 crore plus they are proposing. The file is pending before the Chief Minister, so we are expecting another 100 plus crore before March.
Got it, sir. And regarding our EPC of BHEL Singareni, so you said around 1 to 2 months will do procuring, so it will start execution in start FY27, right?
Sorry, which one, sir? Singareni we are executing, sir. 100 crore we are expecting this Q4 revenue.
Okay, got it. And regarding BESS, so when do we expect to achieve financial closure?
This actually we have, as per the agreement, 9 months time is there from the date of agreement. So this mid of this month we are signing the agreement. So we have 9 months time after that to close the financials.
Agreement is by
mid of this.
Okay, got it, sir. Thank you so much.
Thank you. The next question is from the line of Bhagwat from Prosperity Wealth Management. Please go ahead.
Thank you for the opportunity. Most of my questions have been answered. Just 2 more points I wanted to understand. Number 1, what is the expected peak borrowing and the corresponding interest rate, considering the MDO segment also peaks by FY28 or 29?
Okay. We are majorly, our borrowing is only the working capital limit so far, and we have equipment loan for 98 crore, and the balance is 700 crore odd is the working capital limits which we borrowed. Weighted average cost of the working capital is 8.5%, and our equipment loans we are borrowing at 7.8%. So blend of around 8.2 to 8.3% average weighted cost will be there. With reference to MDO is concerned, the KBP mine, we are raising term loan of 256 crore. We have not drawn that money. We are raising at 9.5% project fund loan. And washery also we are raising loan at 9.5%.
Okay. On total basis, what we can expect the total number of borrowings?
As of now, it is 833 gross debt as of December, sir. This will go up another 400 crore by next year.
Okay, 400 next year. Okay. And second question, what's the effective tax rate on the full year basis on consolidated numbers?
Sorry?
The corporate tax rate on consolidated book.
Yeah, this is 25% on the main company, and there are the increase in the corporate tax is mainly some of the sand mines are on LLP names. So LLP where the tax rate is 35%. When we are consolidating that revenue, your average cost is coming is a higher side.
But can you please comment, like, can you expect around 28 or 29? That's what you can expect on consolidated number?
No, it will come to 2.8 to 2.9% average. 28%, yes, average.
Okay. Thank you, sir.
Thank you. The next question is from the line of Amar Ahir from Radiant Capital. Please go ahead. Amar, you can go ahead.
Hello, am I audible?
Yes, sir.
Just one last question. That where do you see strong demand in across all your verticals?
Sorry, your voice is breaking, sir. We are unable to hear.
Your voice is breaking, Amar.
Is it fine now?
Yeah, no better.
Yeah, I was asking that from which vertical of yours do you see a strong demand going ahead?
The power sector is the major vertical where we are going to get new orders from the power side. O&M also, O&M power. And now we are venturing into the O&M of non-power also. Recently we won the monorail project of Bombay. We had to receive the order. So we are majorly expecting orders from the power side.
Okay, sir. Thank you so much. That's it.
Thank you. We'll take the next question from the line of Vedant Kabra from AVN Capital. Please go ahead.
Hi, ma'am. Am I audible?
Yes, sir.
Yes, I just have a follow-up question on the labor laws. Just to estimate for the worst case scenario, assuming the labor laws go into full implementation, do we have a quantifiable EBITDA margin impact?
Our labor component of the total cost can be about, say, in the service jobs it is 50 to 60%. And in the 50-60% for the service installation, O&M, etc. Whereas in the material-based contracts it will be less. But absolute figures cannot be there because we pay to the contractors based on the item rates of the fixed rate. And the actual values on which the labor payments are made is we don't have a specification on it. But on a broad basis we know that these are the.
So we have limited impact on this rate variations because of the PVC clauses and minimum wages already we are implementing. So there are no much impact for the Power Mech.
So just to assume, let's say the cost goes up by somewhere between 8 to 10%. In that case, what will be our EBITDA impact?
That's what I'm saying. We can claim the PVC from the client, so our revenue also will go up. The compensation will come from the client, so we'll pass that compensation to the subcontractor.
Okay, this is true for even the locked-in contracts?
Yes.
Okay. And sir, just last question. What is your current understanding on this implementation timeline of the labor law codes, especially across the states in which you are operating?
See, there are certain, actually it is applicable from April. Certain people are saying it is applicable from certain April onwards, 1st April onwards. But the Act is already announced in the month of November. We are creating provisions in the Q3 itself for the existing liabilities in the books. And actual implementation will be from 1st April. So there are various interpretations are there. Now we are seeking clarification on that. But with effect from 1st April only, generally the government will implement this.
Okay. Thank you so much. That's all from my side.
Because there are rules to be framed from the government side, so there is a delay.
Okay, noted. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to the management for closing remarks.
Yeah, thanks for the participation from the team, and thanks Arvind and his team. I think looking at the what we can say is that a reiteration of the profile of investment. Government is bullish on investment. Now private sector is coming in a big way, mostly in the power sector also. Power sector capacity expansion will go from it will go up to 320 gigawatts. Maybe earlier they were planning 80 gigawatts addition from 220, they may go to 320 gigawatts. That will add, as on today, I told you about 55 to 60,000 gigawatts have been added. And then some more ordering will come up because the projects which are in the pipeline development is about 35 to 40,000 megawatts. Therefore, this will happen in the next 2 years. And then, of course, nuclear power, we have to see the catch there. Present capacity of 9 gigawatt, it will go to 20 gigawatt. And battery storage, where we entered recently, government is very bullish on that. Battery storage, pumped storage, they want to increase the capacity to battery storage to 47 gigawatts by 31-32, and pumped storage from 4.75 gigawatt to 18.8 gigawatt. In fact, we are looking at some of these opportunities of pumped storage. It brings on the synergy in our working system on the civil and the electromechanical packages, and we are discussing with some of the players also on that. Therefore, then O&M, as I said, the increased capacity addition of 8 to 10,000 megawatts, they add on opportunity about 1,200 to 1,500 crores. That will be every year it will be getting added. It depends on how much we can capture that and who are the customers who will be keen to take that O&M in-house or outsourcing completely. Well, that is how we are there looking at it, and we hope that next year also we'll have a growth of 20-25%.
Thank you very much. On behalf of Nirmal Bang Equities Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.